All right, guys. So we got a lot to cover. I had no plan for this whatsoever. I didn't take any notes. I didn't write a script. I didn't write anything down. So this is the 0 to 100 trading 101 video. So yeah, the number one thing you need to know: this shit ain't fucking easy, man. And this shit is not no gambling. This shit is not no get rich quick. This shit is very technical. It's very psychologically taxing. And the reason it's very psychologically taxing is because it's going to show you all of your own flaws, and they're going to be almost impossible to fix. You're going to be stuck in your ways. And if you think you're going to come in here and you're going to make a whole bunch of money within a few months, 99% don't. So if you really want to try your luck with the one being the 1%, and you think you're going to come in here and you're going to buy some meme coin in crypto and you're going to throw $200 in and it's going to go to 200,000, good luck. That's not real trading. That's gambling. Do I think it's do I think it's better gambling than going to the casino or buying lottery tickets or whatever the case may be? Yeah, I do. But that doesn't change the fact that it's gambling. So that's not what we're here for. It's not what we do every day. At least we try to avoid it, you know. I'm a year and a half into this journey, so I still make mistakes all the time. And I still get frustrated and flustered all the time, and I'll over leverage and I'll over trade and I'll revenge trade and stuff like that. So I'm not saying I'm some guru, I'm perfect and shit. Um, Try to be transparent here. So that's just the reality of the situation. Why the fuck am I blurred? It's just the lighting. Hopefully it'll fix itself in a second here. But um, all right, guys. So I guess we're just gonna get right into it. I'm gonna go on TradingView and I'm going to tell you what I would do if I knew nothing. So all right, guys. So yeah, stocks, futures, options. You got to pick one and everything like that. We're gonna go over a couple things: tick value, uh, point value, all that kind of stuff. Um, so yeah, we'll get right into it. Okay. Let's see. Let's see. I'll go over to this window here. All right, guys, I'm logged into this futures account. It's going to be a prop firm. I'll go over what prop firms are as well briefly, stuff like that. We'll get right into it. So this is NQ. NQ is going to be an indice. It's going to be essentially a basket of stocks represented by one stock. It's kind of, like I said, a mix of stocks. Um, NQ and ES are the primary, instruments a lot of people trade. Also US 30 as well, Dow Jones 30. Um, I also trade gold and stuff, but you can trade a lot of things with futures. Oil prices, platinum, silver, cattle, even rice, soybeans, the price of all types of shit you can trade up and down. Um, but yeah, I'll be showing you how to calculate your risk real quick and everything like that. A lot of people think it's all this big math. It's no calculus, it's no trigonometry, it's nothing crazy. It's basic multiplication, division, addition, subtraction that you're going to have to be doing. So not a big deal at all. Let's get right into it. So when you're on the computer, you go up to this bar here, click on these three dots, security info. You can see the point value here. The point value is going to be how much per dollar are you making or losing for one contract. You can also do micros. So this is going to be for a mini contract. A micro contract is going to be only 1/10 the size of a mini. So if you're going very small, that's how you would trade, is you would just do the same thing. It would be micro. And this point value here would say 2 instead of 20 on NQ. Anyways, how do you determine your risk? You just simply do the multiplication. If it's $20 per point per $1, how many dollars is it moving? 50 bucks, 50 times 20 is 1,000. That's 1,000 bucks. So how do you determine your risk? How do you determine the right thing to do? Well, how much are you willing to risk? What is a reasonable stop loss? How much does it move and how quickly? How long do you want to be in a trade for? Are you going to be in a trade for days or weeks? Are you going to be in a trade for a couple hours, the full day? Or are you going to be in a trade for only a couple minutes and you'd be considered a scalper at that point? So again, it's a lot of picking your style, picking what you're comfortable with and everything like that. But this is how you check the point value for instruments and everything like that. and you can see yeah, how to determine your risk and everything like that. We'll do one more example. We're going over to gold here. We're going up to the three dots. We're going to security info. It's going to be $100 per point on gold. So if you're in one contract and it moves $1, you made or lost $100. Okay, let's do another example real quick. If you are in 7 contracts and it moves $4, that's going to be $700 per dollar times 4. It's going to be $2,800. So you get the point. Pretty basic multiplication, division, addition, subtraction is all you need for trading. Other things are very complicated, but the math portion of it is not very complicated, guys. Okay, let's do tick size real quick. Tick size is the smallest amount. Typically, sometimes they split the tick in half, but typically the smallest amount that the instrument that you are trading can move. So gold is 0.1, so it's moving 10 cents at a time. It's moving in 10-cent increments. That means that on one contract for one tick, that is $10. Because of course, $1 is $100 per contract. So one tick is 0.1 on gold. That is equal to $10 per contract. So let's go back to NQ real quick. We'll do that same example. Boom, boom. And we see here for the tick size for NQ and ES as well over here, S&P 500, the future version of S&P 500, ES, is also going to be a quarter, 25 cents. So that means that, yeah, basically on one contract, every tick is going to be worth $5, 0.25 times $25. So, yep, for every dollar, 20 bucks. For every tick, $5. That's how you do the math there. Not too bad at all. Basic multiplication for the most part. So, yeah. So what you need to determine, how much do these things move per day? What am I comfortable with as far as what portion of that do I want to grab? If you want to grab all of it, you might have to have a wider stop loss. You might have to give it more wiggle room and everything like that. If you're only looking to capture a small amount of it, maybe your stop loss can be pretty tight, but you're going to have to take profit pretty tight as well. More of a scalper. So yeah, think about your personality and think about what makes you comfortable. Do you want to be going to bed multiple days in a row with this trade running and you see huge profit and then it goes all the way back to break even, you get stopped out? That shit's annoying. It's not my style. But a lot of people do prefer the swing trading just because you can go lower size. You can get huge moves. You can catch huge moves throughout a day, couple days, a week. I mean, you can catch massive moves, but it's just a lot of waiting. And dude, I'm pissed if a trade goes back to break even after like 30 minutes. And I was way up, and it goes back to break even or whatever. I'm pissed after 30 minutes. I'm like, fuck, I just wasted that 30 minutes. Should have took profit. Imagine waiting days or weeks. You're way up, the shit goes back down over another series of days or weeks, all the way back down to break even. I couldn't do it. I'm gonna be pissed. So yeah, that swing trading shit is for rich people, dude. I don't know. You're gonna be in and out, gonna be making money, gonna be taking what you can get day by day. So that's just my opinion. Let's see, what should we go over? So paper trading, guys, you're going to want to be paper trading in the beginning. There's no reason to load up an account with your own personal money when you know nothing and you're just going to lose it. Shit is stupid. So you're going to want to make a TradingView account. You're going to want to go down here, log out real quick, and you see paper trading is the very first option here. I'll log into my paper trading account. Here's the difference with paper trading, guys. And this is where it gets a little bit complicated, a little bit nuanced, okay? For futures, you have to pay a market subscription fee. It's like 15 bucks per month to be able to see the candles move in real time because there's just centralized data feeds and whatever. Probably just because of the fact they want to make money. I'm sure they could offer it for free if they really wanted it to. You're paper trading, you are not on futures. So how do you get around, and you don't have to, you could easily pay the $15 a month and just trade a paper account on futures. But if you don't want to do that, if you don't want to pay the 15 bucks a month, then how can you get around that? I'm about to show you. So say if you're trading gold. Let's go down here. So gold, the Forex version of gold or the spot version of gold as well, you can see it says gold spot here, is going to be ticker symbol. You see it here, XAU USD. XAU USD. Okay, so You're going to go to XAU USD. I have it from forex.com right now just because of the spread is actually low. It doesn't show here because the market's closed, but when it opens up, you'll see that the spread is low. It's just the spread is just the difference between the price of a buy and a sell. You want it to be close together as possible because it's going to put you in the opposite whenever you enter a trade. So whenever you enter a trade, you're automatically down a little bit. It's a little bit scary. I know that sounds crazy. It's just one tick though. It's literally just one tick. You're down basically one tick when you enter a trade because of the difference between a buy and a sell. You have to do the opposite of what you did to close a trade than when you opened it. You know what I'm saying? So the difference between the buy and the sell is should be one tick on futures. Yeah. So how do you get around paying the $15 a month fee and practicing for free? Remember, the point size, the contract size for gold for futures was 100. This is only one share, 1 ounce of gold, this XAU USD spot gold. So what can we do? We open up the paper account, we type in XAU USD, we find one with the lowest spread between the buy and the sell. Again, this is looking shitty, but it's just because the market is closed. The spread is actually very good. It's like only a couple cents. Yeah, and you multiply by whatever the contract size is, since this is only represented by one. You can do the same thing with NQ, multiply by 20. You can do the same thing with ES, multiply by 50. And for gold, you multiply by 100. So normally, if you wanted to trade 3 contracts, you'd go into the trading window, and instead of 3, you would just type in 300, because that is represented by 300 shares, because in futures, the contract size is 100. So you practice for free, again, by coming over, you search for XAUUSD. For NASDAQ, you would probably type in NAS 100. For ES, you would type in S&P 500. And you multiply by whatever the contract size is to practice for futures. Okay? So again, go into the trade window. Say if I would normally be trading with 5 contracts in futures, for normal spot gold, that would actually represent 500 ounces. It's very simple. And the only difference is with this is that normally ticks are in 10 cents, but this is going by pennies. So instead of 10 cents, going by 1 cent. So for example, 800 ticks here is represented by 800 ticks represents $8 here, is what I'm trying to say. Jesus. In futures, $8 would only be 80 ticks. Why? Because here we're going by pennies, and in futures we're going by increments of 10 cents. So it's just a multiplied, factor of 10 basically. 80, 800. Very simple multiplication. And you can see that this is 37 here. $8 away is 45. So 800 ticks, that'll bring you to 45. So you can see everything makes sense. You can double check your work here. It's really not hard. It types everything for you. It even tells you the percent that you're risking, the amount of USD, US dollars, the price you'll be at once it moves that many ticks. I mean, it's telling you everything. You have to type in one of the factors, and it types in everything. It fills everything out for you. So, again, all the math stuff is really not hard. It's just a little bit to get used to and where to look and what to multiply by. It's all based on the contract size. Normal spot is the contract size is always going to be 1. It's just a share basically. It's normal. Futures, the contract size is going to depend on the specific instrument. For NASDAQ, it is 20. For gold, it is 100. For ES or the S&P 500, futures version of S&P 500, it is 50 for the contract size. So yeah, guys, what do I recommend you do when you actually start trading? Well, you're going to have analysis paralysis. You're not going to know what to do. You have a paper account that you can reset unlimited fucking times. I suggest you start clicking buttons and practicing and seeing what happens, because there's no consequence. You're only going to get better. Don't just sit there. Don't just watch a million fucking YouTube videos and think you're going to get better and write in your little notebook and shit, but you never even take trades. You're just writing random notes about what you watch on the video. Don't do that. Do all that, Study hard, watch YouTube videos, write it down in the notebook. I'm not saying not to do all that, but I'm saying it means nothing if you're not really trading. I mean, like, what the fuck are you studying? Like, you're just studying these people trading and then you're not going to do it yourself. Like, isn't it your goal to be a trader? Why are you not trading? So I never understood it. I never understood people who just take the notes and watch the videos and stuff and they never trade. They always say they're interested in it and this and that and the other. I mean, paper trading is free. What is stopping you? You can set orders. You don't have to sit there and stare at the chart all day to be a trader. You can predict the move, you can set the order, and you don't even have to watch it. The trade happens. You get tagged in, you get tagged out automatically. So a lot of excuses out here. It's just like people get, and it's no hate. People are interested in trading. They realize how hard it actually is. They become uninterested. So I get it. But yeah, if you want to take this shit serious, just start clicking shit. Buy, sell. There's only two buttons. Figure out a good stop loss size for you. Figure out a good take profit size for you. Be consistent. Have discipline. Take only 1 or 2 trades per day. And just practice. Get better. So yeah, we'll do more beginner videos and stuff like that. I think this is a really good start. I'm gonna put just like a couple terms. Again, I learned trading from ICT. Learn trading from whoever you want. Uh, I believe ICT has an insane accuracy. I believe his concepts are just unbelievably accurate. And I do believe that there is an algorithm controlling the markets and that he is in some way, whether he coded it or not, or whatever crazy shit he be saying. I know a lot of people have a lot of controversial things to say about ICT, but clearly there's something to the shit because thousands and thousands of people, you see it, um, profitable from his concepts. You go on Twitter, you go on Jade Cap. Every prop firm is saying Jade Cap is the most profitable person of their prop firm. He's gotten over $1 million of payouts. He's an ICT student. So it's like, clearly there's something to this shit, okay? I'll go over a couple terms and things like that I believe you should look into for ICT and pretty much call it there. Yeah. I'll, I don't even know where text is here. There we go. Okay, so ICT terms. Um, Daily bias is probably arguably the first or second most important because if you have the direction of the day right, you're automatically at such an advantage. You just need to find the proper entry where you won't get stopped out. So daily bias, pretty self-explanatory. It's just your bias of whether you think it's going to be going up or going down for the day, bullish or bearish, daily bias. And you learn that by studying structure. I think the 1 hour is very important for daily bias, the 1 hour chart. You can very clearly see structure a lot of the time. And yeah, I like it. I like the 15-minute a lot too for daily bias. So yeah, that one's pretty self-explanatory. Daily bias. Um, the also, number 1 or number 2, most important here, liquidity. We'll put liquidity sweep. Okay, so liquidity or liquidity sweep. How do we describe that? We describe that essentially as a fake out, guys. It's just a fake out. So let's see. This is going to be a pretty good example. Let's take these two highs here. Okay, I'm going to draw a line here. This is just a very quick example. We have a swing high here. It gets broken here. And it looks really good too. There's a long tail to the bottom here, so it looks like it's just getting fucking sucked up here. It looks stupid bullish, but what really happens? It barely breaks the first high here. It goes just a little bit over it, and then the rest of the day you get destroyed. So what happened? Not destroyed. I mean, obviously, if you're in shorts, you're making a lot of money. But what I mean by that is that people get tricked into going long because it's breaking this high, and a lot of people are breakout traders when in reality this scenario is going to be a fake out. It breaks the first high here. You think it's going to fucking skyrocket after that. Really, it barely breaks the high, and the rest of the day is completely bearish. So liquidity sweep is just a fake out, guys. Study, look at your equal highs and equal lows. Look at your swing highs and swing lows. And Yeah, that'll give you a really good start there. Let's keep going. Um, as far as liquidity sweep, there's also turtle soup, which is basically just like a stop hunt on early buyers or early sellers, kind of like a short-term liquidity sweep in a sense. So I kind of would consider this a turtle soup entry, but they're kind of similar. So think of turtle soup and liquidity sweep together. And we'll go over a couple more terms that I think are super important in ICT. I'm just going to write them all down at the same time here. Fair value gap, order block, um, new day opening gap. Here, we'll put these on the same one. New day slash week opening gap. So that's pretty self-explanatory. We'll just go over that first since it is pretty self-explanatory. The From the close to the open, if there's a gap in price, new day opening gap. If it happens over the weekend from Friday night to Sunday night, when the market opens back up, that's a new week opening gap. So just the gap in price between the close and the open. Very self-explanatory. You mark that out with a rectangle or a box, whatever you want to call it. You have a midline in that box so you can see the middle of because it might hit the exact midpoint due to the algorithm. How could that possibly happen randomly? It wouldn't. It hits the exact midpoint of the opening gap. Okay, so pretty self-explanatory there. New day or new week opening gap. Fair value gap. Fair value gap. What is that? That is going to be 3 candles in a row, either bullish or bearish, and it is going to be the wick of the first and third candle, creating a gap in the second candle. So let's see if we can find a really good example where a fair value gap got filled like pretty much perfectly. Honestly, I really like this right after the turtle soup, and that is where the best area to look for a fair value gap. You want liquidity sweep, market structure shift, fair value gap, enter on the fair value gap. That's basically the 2022 ICT model right there. Okay, so look at this. We have multiple red candles in a row. Let's stretch this out even more. Right here, the wick right there, wick right there. If we wanted to mark this out, we'd do it like so, from wick to wick, fair value gap, and look at this, how it respects that, and it goes down. The wicks come up in there. They even break it a little bit because it is quite the small fair value gap, so I'm not surprised at all that it broke it by a tick or two. But look at the respect there. This is only the 5-minute chart. We can go all the way down to the 1 minute and see how well it really respected that. Oh man, beautiful. I mean, even on the 1 minute, the bodies are inside, the wicks are outside, complete rejection. I mean, that's beautiful. So fair value gap, 3 candles in a row. You take the wick on the first, the wick on the third, and you mark out the gap in the middle on the second candle. The candles are supposed to be all of the same color. Some people are marking out fair value gaps that are not 3 red or 3 green candles in a row, or 3 up, 3 down candles in a row. I don't think that's correct. Someone can correct me if ICT has said otherwise, but I don't think that's correct. I don't think you should just be marking out, a up candle, down candle, up candle, and just because there's wicks on all of them, that's a fair value gap in the middle. No, I don't think so. So what else we got? Order block. Order block is going to be the last candle in the opposing direction before the large move down. Okay, so let's see if we can find a random example. Again, this video is completely unscripted, unpracticed, all that, so I gotta find one real quick, a good example, unfortunately. Uh, let's look for a nice example. You can see quite a few in which we can probably use that, honestly. We probably will use that example since this market is so bullish, and that's actually a good thing to teach as well. So, this is the 1 hour chart, guys. Um, we have this manipulation candle here. This is going to be the last up candle before this huge down candle right here. It doesn't look that huge because I'm on the 1 hour and I'm not that stretched out. Let's stretch out a little bit more. So what does this Last manipulation candle up before the huge move down. Okay, so this is the order block then. It can also be a series of candles. You see how it's two up candles in a row. So technically that whole series of candles is the order block. You're only going to mark out the bodies. You're not going to include the wicks. Okay, so that is the order block from there. And you can see, look at this. Look at this. This can't be random. I mean, people who don't believe in the algorithm and think that the market is actually based on buying and selling pressure, I don't understand. Because you're telling me that an exact amount of people just so happen to be buying and selling at this exact time when it comes up into the order block, that it hits the exact midpoint of the order block, breaks it by a tick or two, and then completely rejects from it, and that happens consistently all the time? How could that possibly be based on a random number on any given day of buyers and sellers? Also, just naturally, this is complete common sense, okay? This is complete common sense. If you have volume up, how on earth would an asset make a new high off lower volume? Boom, it automatically doesn't make sense, and it's that simple. The market is run by an algorithm because it wouldn't be possible for markets to make new highs or new lows without continually increasing volume to get to that new high or low. You'd have to have more people trading it than previously to get to the new high or low. So how are you getting to new higher lows with less volume? That would only be possible via an algorithm that sets price. So I don't get it. I don't get when people don't believe in the algorithm here. I really don't get it. But you can tell this is bullish as well because look at how it missed the midpoint right here. It goes up into the order block area. It comes back down. Now it pushes nice into the middle area. It consolidates at the bottom of this order block here. You can see it's there for a few hours. 1, 2, 3, 4, 5, 6, 7, 8. It was there for 8 hours consolidating on the bottom of that order block that I have marked out with this box here. And it continued up because we are bullish. Gold is extremely bullish, guys. We're hitting new all-time highs all the time with gold. So that's what's going on right now in that market. Pretty bullish. So, yeah, guys, I pretty much went over everything. You know, liquidity sweep is just a fake out. Look out for the fake outs. When it breaks a high, breaks a low, that actually could be indicating a reversal, not a breakout. Fair value gap, 3 candles in a row. First wick to the third wick creates a gap in the middle. Order block, last candle, last manipulation candle before the big move in the opposite direction. New day and new week opening gap, pretty self-explanatory there. Yeah, guys, this is a great video for beginners right now. This is a fantastic video for beginners. We went over how to calculate risk, tick size, and point value. We went over making a paper trading account and just going for it. We went over all types of stuff. The last thing I'll go over, I think for now, is going to be important times. So this algorithm, and everybody knows this, whether they believe in the algorithm or not, certain times are very important. Okay, futures is 24 hours a day for 5 days a week during the weekdays. However, the stock market opens at 9:30 for regular accounts. Okay, so you can't be trading outside of regular hours, 9:30 to 4:30 or whatever it is. Yeah, you're only doing that in futures and Forex. You're trading 24 hours in futures and Forex. And I would recommend futures over Forex due to regulation and due to the spreads being much better and stuff like that. So you're going to want to do futures if you can rather than Forex. There's really no reason to do Forex when you can do futures. You get, safety of your account being regulated and everything like that, the broker being regulated. You get better spreads. There's really no reason to do Forex, and in my opinion. And you can trade foreign exchange on futures as well. So Euro USD is going to be 6E. So you just type in 6E to find that. The Japanese yen is going to be 6J. So it's always just 6 and then a letter. 6G is going to be Great British Pound. Or no. That actually might be 6B. It's 6G or 6B. I don't know. I don't trade the currencies. So, but yeah, you're just typing in 6 and then a letter to find the currencies if you want to trade those. Where was I going? The last thing that we're going to go over was, oh yeah, important times. So red folder news often is coming out at 8:30 a.m., 10 a.m. Stock market open is going to be 9:30 a.m. Of course, midnight is just a new day in general. So all these times are going to be very important. 2 to 3 a.m. is going to be peak London hours. So London session, again, Forex and futures are going to be 24/7. The whole world's trading them and everything like that. So London session, peak London session is about 2, 3 a.m. for us, New York time. I live in Florida, so we're going off that New York time. Yeah, so definitely take note of important times and write down in your journal when certain moves happen, and you'll definitely notice that it's very similar pretty much every single day. 8:30, 9:30, 10 o'clock, big moves are happening. Of course, it's pretty obvious when big news is dropping, big economic news. And that's a sidetrack, actually. Well, you're going to want to use forexfactory.com to check for red folder news. It's just easiest, in my opinion. I just like the way it's just on their front page. It's color coded by how important the news is and everything like that. Red folder news oftentimes is going to move the market largely, especially CPI, NFP, and FOMC. Okay, CPI, FOMC, NFP, those are the three big ones that will blow your account if you're not careful literally instantly. So please be careful, guys, trading red folder news. It can get crazy. And your stop loss will not work with red folder news. The price will literally jump largely, so it will skip directly over your stop loss, and you will be fucked and sad. So if you're not prepared for that, size down significantly or don't trade the crazy news at all. And yeah, we'll go over what a prop firm is, and that'll pretty much be it. So a prop firm is basically a company. You take an evaluation, a test basically, in which they give you a paper trading account, demo account, not real money. You have a profit target and a profit target and a loss amount essentially. You have to hit the profit target without hitting the loss amount, and then you've passed the evaluation, and now you have an account in which you can actually withdraw money from. So you pay the money, you pass the account, and you can now have access to funds that you can actually withdraw. There's a set of rules, and the loss amount still applies, and everything like that. So it's very difficult. It's very frustrating. And I'd recommend, of course, paper trading and not even doing any prop firm challenges until you're pretty good. But yeah, it's definitely a way, a medium of, loading up thousands of dollars of your own personal money into an account and risking it versus, you could pay, $20, anywhere from $20 to $500 or whatever for a decent sized prop firm account. And, you can practice with that, so I recommend my funded futures and my funded Forex for prop firm accounts. I've gotten payouts from them very quickly, very easily, no problems. So I definitely recommend them. You got to be careful out here. Some prop firms are scams. You will do everything correctly. You will follow their rules and they will not pay you. So make sure you are using a reputable prop firm. Yeah, my funded futures, my funded Forex. A couple other ones, legendary in there. FTMO, I don't think Americans can use. Funding pips, I think Americans can still use. E8 markets is always, known for having a good reputation, everything like that. I've heard very few bad things. So yeah, be careful which prop firm you choose if you do trade with a prop firm. Again, basically just an evaluation. You pass the evaluation. At that point, you can actually take money from the account after you passed. And it is, every 2 weeks or so. That's usually average every 1 week, every 2 weeks, depending on the prop firm. You can take the withdrawal. You still have to follow their rules and everything like that. You still have to abide by the loss amount, all that kind of stuff. So, yeah, can be helpful, can be frustrating. I definitely recommend going through the prop firm journey before you load up a fat personal account. I definitely recommend it. But yeah, guys, this has been a really fantastic introduction. I know it's a fucking lot of information, but just try to break it down. Basic multiplication, tick size, point value. What am I trading? When am I trading it? How much am I risking? How long do I want to be in the trade? And base all this on your personality, on your preferences, on your patience levels, and all this kind of stuff. Obviously, try to work on your patience and everything. It's going to be required for trading, regardless. Because even if you're in a trade for not that long, how long did you have to wait for that setup? You might have had to wait a day or two for the setup, even though the trade will only take minutes. So it's gonna require patience regardless, is my point. So work on your patience, but definitely cater your strategy to your natural personality. Don't try to force your personality be too different. Obviously, work on your flaws, but there is a balance to that. You know, you do have to work with what you got. So, yeah, guys, this has been a great introduction to trading. I'll probably do more beginner videos like this with, if people have questions and everything like that. So, yeah, guys, thanks for listening. Hit me up with any specific questions or anything like that. Leave comments, leave a like, subscribe, all that kind of stuff. We're going to be back for some live trading on this future account. I'll also be doing a video about how I coded this indicator that automatically marks out the 9:30 open, the midnight open, and the 6 p.m. open. It's fantastic. Um, so yeah, guys, that is how we're doing it. Um, yeah, I meant to end it right there. That would have been like a clean, like, all right, boom, end. But all right, guys, for real. See you later. Thanks for listening.